The market is currently closed as today is Sunday, March 22, 2026. BigBear.ai, trading under the ticker symbol BABI, ended the last full trading session on Friday, March 20, 2026, at a price of $3.58. This represented a notable intraday drop of 4.15% from its opening price of $3.68, with the stock touching a session low of $3.50. While the broader indices have shown signs of fatigue, the selling pressure on BABI specifically stands out because it suggests a widening gap between the hype of the artificial intelligence sector and the hard numbers these mid-cap players are actually producing. Most investors look at a $3.58 price tag on an AI-focused firm and assume they're getting a bargain on a future titan. But the reality is that the market is currently repricing the risk of companies that are struggling to turn a massive backlog into immediate bottom-line results. While you might see headlines about AI expansion, the tape shows us that institutional players are trimming positions, likely rotating into more established names like Nvidia stock or Apple stock, where the cash flow is already a proven quantity rather than a forecast. The expectation for BigBear.ai was a steady climb back toward the $5 level following their recent Q4 earnings beat, where they reported an adjusted loss of only $0.01 per share against a projected loss of $0.06. That is a massive surprise on paper. However, the reality hitting the market right now is a 37.7% year-over-year revenue decline, which came in at just $27.3 million. When revenue is shrinking in a sector that is supposed to be in a hyper-growth phase, it creates a massive psychological rift for investors. People want to believe in the decision intelligence narrative, but they are seeing a company that, despite its wins, recorded a $53.4 million asset impairment charge recently. This tells us that the value of their previous acquisitions or internal assets isn't holding up under the current economic scrutiny. This is exactly why we see such high volatility and why many retail traders are turning to tools like Schwab Intelligent Portfolios or a SoFi robo-advisor to manage their exposure. The manual guesswork in this specific microsector is becoming increasingly dangerous for the uninitiated. If you look at the trading volume on Friday, over 32.5 million shares changed hands, which is significantly higher than its historical average when the stock is just drifting. This suggests a high conviction move by sellers. When a stock breaks below its 50-day moving average on high volume, it usually signals that the expectation of a quick recovery has been abandoned by the big money. We are seeing a similar trend across other popular retail names. Whether it is people checking their Robinhood investments or managing a more complex interactive broker's account, the sentiment has shifted from buy every dip to show me the revenue. Even for those using Fidelity brokerage or looking for stability in Fidelity ETFs, the exposure to high beta names like BABI is being questioned. The common ground here is that everyone knows AI is the future, but the deeper, more cynical reality is that not every company with AI in its name is going to survive the transition from a speculative asset to a fundamental business. Comment below how many shares of BigBear.ai you currently hold, or if you have completely moved your capital into more stable tech names. The recent price action is also a reflection of the company's capital structure. Management did a smart thing by converting $125 million of convertible notes into equity, which technically cleared some debt off the books. But in the world of online investing, equity conversions are a double-edged sword. While the balance sheet looks cleaner, it results in dilution for existing shareholders. If you are holding BABI through a Fidelity mobile app or a Robinhood app, you are now owning a smaller piece of the pie than you did 6 months ago. This dilution, combined with the director share sales we saw earlier this month, specifically Pamela Joyce Braden selling 80,000 shares, paints a picture of a leadership team that is realistic about the long road ahead. When insiders sell, even if they keep a large portion of their holdings, the market reads it as a lack of immediate catalysts. It tells the self-investing crowd that there might not be a moonshot coming in the next few weeks. To understand why the stock is behaving this way, we have to look at what BigBear.ai actually does and why it was so hot to begin with. The company provides mission-ready AI solutions specifically for the defense, national security, and critical infrastructure sectors. This isn't consumer-facing tech, it's deep integrated predictive analytics used by the Army and other government agencies to make high-stakes decisions. The business model relies heavily on massive government contracts, which provides a backlog of over $376 million. In theory, that backlog is a safety net. In practice, government spending is famously lumpy and subject to political delays. When the company missed their revenue targets recently, they blamed lower volumes on certain Army programs. This highlights the reality that even with a massive backlog, you are at the mercy of federal budget cycles. This is why BABI is often compared to Palantir, but Palantir has successfully diversified into the commercial sector, whereas BABI is still very much a government-first play, which carries a different set of risks for those engaged in online investment. For the active investor using a SoFi trading platform or an interactive brokers platform, the technicals are looking quite grim. We are seeing a series of lower highs and lower lows since the peak in early 2026. The 200-day moving average is now acting as a ceiling rather than a floor. This is a classic distribution phase, where the smart money is slowly exiting while retail investors are left holding the bag, hoping for a return to the $9 highs seen last year. The institutional activity shows that while some smaller hedge funds are nibbling at these levels, the major institutions that drive price action are staying on the sidelines. They are waiting for the company to prove it can integrate its recent acquisitions like Ask Sage and Cargo Seer into a cohesive, profitable machine. These acquisitions were intended to expand their reach into the UAE market and commercial trade risk management, but the integration costs are eating into the margins right now. If you are looking for investment help or searching for the best investing sites, you will often find BABI listed as a high-risk, high-reward play. But the reward side of that equation requires a massive shift in macroeconomic conditions. With interest rates remaining a concern and geopolitical tensions in the Middle East pushing oil prices higher, speculative tech is the first place where liquidity gets pulled. This is visible when you look at how BABI performs relative to Nvidia stock or Tesla stock. When the magnificent names take a breather, BABI tends to gasp for air. It's a high beta stock, meaning it moves much more aggressively than the market. If the S&P 500 drops 1%, BABI might drop 5%. For a self-investing individual, that kind of volatility can be stomach-turning if you don't have a clear exit strategy or aren't using sophisticated tools like those found in Fidelity Wealth Management or specialized interactive brokers trading accounts. Looking at the future outlook, the next big catalyst is the Q1 2026 earnings report scheduled for late April. The market is expecting an EPS loss of around $0.07. If they can beat that, and more importantly, show that their revenue is finally starting to scale with their backlog, we could see a massive short squeeze. The short interest in BABI remains elevated, as many traders are betting on the company's cash burn to eventually catch up with it. However, if management can demonstrate that the Ask Sage integration is driving new commercial contracts, the expectation of failure will clash with the reality of growth, and that is where the big gains are made. But until then, the stock is likely to remain in this choppy, downward-sloping channel. Those using Robinhood fractional shares to build a position are essentially betting on a long-term turnaround that may take years to fully manifest. The central insight here is that BigBear.ai is currently a victim of its own narrative. It was sold to the public as an AI powerhouse that would mirror the growth of the biggest names in the industry. The reality has been a series of revenue misses and asset impairments that have forced a re-evaluation of its true worth. While the company has a solid foundation in the defense sector and a respectable backlog, the transition to a profitable, diversified AI firm is proving to be much harder than the initial hype suggested. We have seen this before with many SPAC-born companies. The initial excitement gives way to a grinding period of fundamental adjustment.